Alright, so welcome to today's class. We're going to treat liquidity void in this class, this section. Okay, so we've done mitigation block, we've done breaker block, and today we are doing liquidity void. If possible, we add fair value gap to it. So what is liquidity void? A liquidity void is a gap in the market where few or no buy-sell orders exist, causing price to move rapidly through that area. Definition and concept. A liquidity void occurs when an asset experiences a sudden drop in market depth, meaning there are very few orders available at a given price level. This creates a temporary imbalance between buyers and sellers, often resulting in sharp, rapid price movement as the market seeks a new equilibrium. These voids are sometimes referred to as order vacuums or vertical ranges because price can move through them quickly without resistance. There's no obstacle on the way as price moves. Causes of liquidity voids. Liquidity voids can arise from several factors. Number one, market event. Major news releases or macroeconomic announcements can trigger sudden withdrawals of orders. Okay, so when there is an economic event globally, especially in the forex market, okay, in the crypto market, okay, it can cause a sudden change in the orders that market participants have placed. Okay, yes, so during these times, major news releases, okay, global news events, happenings in the world, economic news, wars, what have you, okay, it can trigger liquidity voids, one of the causes of it. Okay, so let's take this Iran-Israel American, this war that is going on. There were certain sharp drops in prices and all that, so it caused or created liquidity voids in the market. So after this theoretical aspect, we'll be looking at the practical examples on charts in the market, okay, where you get to know when we say liquidity voids, you now understand and know what liquidity void stands for. Okay, so secondly, institutional trades. Large orders from institutional investors can sweep through price levels, leaving gaps. Okay, so when the big boys, the big players in the market, okay, the market movers, they place big or large orders, okay, sweeps through the market. Yes, so it also creates liquidity voids in the market. Okay, and we have off market hours. Reduced trading activities outside core market hours can create temporary voids, yes, in the market. So in the forex market, we have the Asian session, we have the London session, we have the New York session, we have the Sydney sessions. So when, let's say, the London session is over, you realize that less trading activities over there. You will see that there are no much buyers and sellers participating. So where there is a presence of, say, more buyers, they can, push price in the direction of its intended move. Okay, so it can also create liquidity void, or it also sometimes creates liquidity voids. Okay, and algorithmic and high frequency trading. Rapid adjustment or cancellation of orders can create sudden gaps in the market. So we have algorithmic traders, those people who use robots and all those things to trade. You see, so when they withdraw their trading orders or they cancel their trading orders on the market, it also, perhaps if there is more selling orders than buy orders in the market, okay, I also create liquidity voice, vice versa. Okay, so market implications: when prices enter when price enters a liquidity void, it often travels quickly because there's minimal opposition from buyers or sellers. Yes, as I said, this voice can lead to increased volatility. Price may spike or drop sharply. It means price can easily move up easily or drop easily. Okay, there is no hindrance on the path of price. Okay, so price can easily drop or move higher easily. So you can place a trade for a buy, and when trade move spikes in the direction of your analysis or your setup or the trade you took, okay, and there is liquidity, less an increased volatility in the market, okay, you will see that sooner than later you hit TP. You understand? Unlike when there's much participant during trading hours where we have more buyers and sellers interacting, and then there's a tug of war in the market. Okay, so what implication is we have increased volatility in the market, and also price gaps. Charts may show discontinuities or straight candles where little trading occur. Okay, so you will see that on the chart you have a spike. You can see one candle move like 50 pips, 100 pips, okay, 200 pips, 300 pips. Okay, so that there are always that gap. So you're going to create a gap. The next candle, the following candle also follows that way. So you are going to see that there is more gap in the market. More gap. You are going to see it on the chart. Okay, and then we have potential retracement. Market often return to fill this voice later, okay, as unmet orders or imbalances are corrected. So when there is liquidity void, you know, market, for us to have a complete transaction, we must have both buyers and sellers present. So if we have only buyers in the market and they have placed more buy orders and they move in the direction of the buy, we have to now have sellers that will come in to fill those voids. The voids over there, we have to have sellers to now come and then fill the voids in the market. That means they are correcting imbalances. Okay, that's it. And then we have trading application. Traders can use liquidity voids to inform strategy, entry and exit point. Voice can indicate areas where price may accelerate, helping traders plan trades. Risk management. Awareness of voice can prevent entry positions late in a fast moving zone, reducing the risk of slippage, okay, in the market. So it's going to help you to know that area that there's liquidity void, okay, there is no any hindrance for price if it will move. So if we have a liquidity void in the direction of buyers and then price is moving to refill those buy orders where sellers are coming in to correct those voids, price will move through that zone. Price easily moves through that zone easily, okay, during that correctional stage. So we have fair value gaps, which we are looking to look up in our as the next institutional trading reference point. So liquidity voids often form basis for patterns like fair value gaps, where price moves quickly through a range, leaving a gap that may later be revisited. Yes, so we are going to look at the fair value gaps also. So key takeaways: liquidity voids are gaps in market activity where price moves quickly due to lack of orders. They are caused by imbalances, large trades, or low market participation. Traders can anticipate volatility, plan entries and exits, and manage risks by identifying these voids on charts. Markets often return to fill voids, providing potential trading opportunities. Okay, so have this key takeaway is a summary of what liquidity void is about. So have that at the back of your mind. I would like us to also look at the fair value gap straightforward, and then when we go to the chart, I'm going to show you both the fair value gap and then the liquidity void in the market. Okay, so what is a fair value gap? Okay, what is the fair value gap trading strategy? The fair value gap trading strategy helps traders spot short-term price imbalances on a chart, often caused by sudden buying and selling pressure. These gaps typically form during periods of heightened volatility, okay, and appear as a 3-candle pattern. So fair value gaps is a 3-candle pattern, okay. That is when we have the first candle, the second candle, and the third candle, and there is a space between the first candle and the third candle, okay. They did not close up either by their wicks or by their bodies. So we are going to see also that. Then we enter the chart to see. Unlike balanced market areas where consecutive candles show overlapping wicks and a fair exchange between buyers and sellers, an FVG, which is the fair value gap, signals a disruption. Specifically, it appears when part of the middle candle's range isn't touched by the candles before or after it, as I explained earlier. Okay. Specifically, it appears when part of the middle candle's range isn't touched by the candle before or after it. This creates a visible gap and suggests that one side temporarily dominated the order flow. Okay, so you understand order flow is the movement of price in a specific or particular direction without an interruption. Traders may interpret these gaps as potential zones of interest where the market could revisit to fill the inefficiency. However, like all chart patterns and strategy, an FVG doesn't guarantee any particular outcome. Okay, so that's simply what FVG stands for. So we'll go to the chart and then we're going to show you the FVG and also the liquidity void as well. Okay, so let's look in the chart. Okay, so you can see over here, okay, from down here to the up here, okay, there's a liquidity void over here. You can see the spike. Okay, you can see the spike in price. You see this liquidity void formed earlier. Okay, this formed earlier. Let me try to change the color of. Let me see. Okay, try changing the color. So you can see this void. So this was created earlier. You see price reversed to correct it, and you can see when price got to this area how it also spiked to fill it, and also here when price was moving to the downside to fill it, it was just dropping. There was no hindrance to it. Okay, so that tells you about what liquidity void is all about. So anytime you see these spikes in the market, they are liquidity voids, and expect price to come back to fill them. You can look at them as a confluence in your trading. But as you want to take any setup, you know that, wow, I have a void over here, so this price definitely is going to move to fill this void over here. So I'm going to say take my TP over here or what have you. So that is what liquidity void means. So you have to understand it. It's an institutional reference point, so it has left gaps. You can see the gap between here and here. You can see the gap between this candle and this candle. you can see the gap over here. You can see there's a gap over here, and you can see also this place, there's a gap over here. Okay, it always leaves a gap. You can see the gap over there. So you when you go through the chart, you are going to see there. You see price came back and filled it, moved to the upside. You see this void, price rebalanced it. So any inefficiency in the market, you see them, price came back, balanced it. You see all these ones were balanced. Okay, so you can see when price retrace, balance these voids. You see this, it was balanced. Look at here, look at this, and you see the way price returned to balance this void over here. It retraced to balance the void. Okay, it balanced it and then did what? Dropped significantly on the downside. Okay, so it rebalanced it. So you pay attention to the chart and then you see all these things. Now let's look at the fair value gap. Okay, it's a 3 candlestick pattern. So you know when we have one candle this way, we have another candlestick this way here, and then we have another candlestick this way. Okay, you realize that this candle, okay, this candle the first one, okay, this one, this first one and this one haven't overlapped. If they overlap, it's either they overlap by their wicks, then we have no fair value gap, we have no gap over here. But when we have this, okay, and there's a space between, okay, this first and then the third one, okay, it indicates that we have a fair value gap, and usually it's used in trade confluences, expecting price to come back to rebalance it, to refill this order before dropping or spiking to the upside or downside. So if this is a bearish fair value gap, we are expecting price to come back to this. Okay, so you draw it by their wick over here. We are expecting price to come back and then fill this gap over here. Okay, fill it this way and then drop the downside. Okay, so it's an institutional reference point, and all this is being arranged in order of importance, of significance. So when you are doing analysis, you are going to see it. Okay, so it is arranged in that order. So this is a fair value gap, and if you have a bullish fair value gap, okay, we have the second one, and then we have the third candle. Okay, this is a bullish fair value gap, and we see price this way. Okay, so in between the first and the third candle, we have a fair value gap over here. So I'll try to make this green. So we have a fair value gap over here in the bullish direction, where you'll be expecting that price will come and rebalance this and then move to the upside. You understand? So these are all important. That is going to help you in analyzing the market. You are going to bring all these things together when you are doing analysis, and then knowing where to take your trades, okay, as a confluence. So this is all for liquidity void. and fair value gaps. Look into the chart, go into the chart, check for it. So when the market is coming down and then we see spikes coming to the downside, they are bearish liquidity voice. And then when market is moving down and we see these 3 candle patterns form, okay, they are what? FVGs, fair value gaps over there, and we expect price to come and rebalance it as it did in this case. So we have liquidity void over here, we have fair value gap as well too over here. Okay, yeah, so you can see, let me zoom in very well. You are going to see the fair value gap, and you are going to see the, as you can see, this is a liquidity void area. Okay, price filled half of it, came back to this place to fill the rest, and then in here we have an FVG over here. Okay, you can see this FVG. Do the color, try to make the color somewhat. You can see this FVG. I want you to see it very well. Between this first and then the third candle, you can see this space. It's called a fair value gap, and that place we have a liquidity void. Over here too, you can see we have a fair value gap over here. You realize that price tapped into it and dropped. So you see what I'm talking about over here on the chart. Okay, it's very, very, very important. So go on the chart, check for this and see how price came back and we balance them. And then once we are done with the entire course, when we are doing top-down analysis and we bring everything together, then you are going to really understand the importance of the 7 institutional reference points, okay, in helping you to make proper analysis and take good trades. Okay, so this is all for now. Take care, and I wish you all the best in your trading journey. Peace. Shalom.